Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith, alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures pushing higher this morning following the April jobs report. Non-farm payrolls show the U.S. economy added 177,000 jobs last month, the unemployment rate holding steady at 4.2%. If the gains in the S&P 500 hold today, it will be the longest winning streak for the index since 2004.
Plus, investors are optimistic on the trade fronts. China said it's assessing the possibility of trade talks with the U.S., the first sign that negotiations could begin between the two sides. China's Commerce Ministry said in a Friday statement that it had noted senior U.S. officials repeatedly expressing their willingness to talk to Beijing about tariffs and urged officials in Washington to show sincerity toward China.
And Apple and Amazon were out with their earnings. Apple's much-awaited quarterly earnings print failing to soothe investor concerns about its biggest challenges, including escalating tariff costs and a slowdown in China. Meantime, Amazon said it's bracing for a tougher business climate in the coming months, echoing concerns from a range of companies that tariffs and related economic turmoil could hurt consumer spending.
U.S. stocks pushing higher this morning as investors cheer the latest jobs report on. But can the job gains and market enthusiasm last? That's the big question here for the sake of this rally and this win streak that we've been watching. Joining us now, Brian Jacobson, who is the NX Wealth Management Chief Economist and Strategist. Brian, great to have you here with us this morning. I want to get your read-in on not just the report, but what it signals for investors who are pretty much cheering everything or anything that they can at this point, as Steve Sosnick from Interactive Brokers had told us during our special report.
Sure. Yeah. Thanks for having me. And I think that this report and the market reaction shows that people are kind of grasping for straws in a way, as far as looking for signs of hope. It does walk that fine line between hope and despair, where the headline number, 177,000, better than expected. We did get those back month revisions. One of the things that I maybe point out the cloud behind the silver lining, which is kind of my job as an economist, is that some of the job gains there were in retail and then also trade and warehousing, which could be due to the front loading of purchases by consumers and businesses to get in front of the tariffs, because this is the data for April. We do know that there was the pause put in, and this could be almost like people making that last dash to get the goods while the getting is still good. So my big concern is that this could be the peak for the jobs number for at least the next few months.
Yeah, and I'm curious what happens to all of those workers when obviously imports are down. We're speaking with the head of the Port of LA later, who's going to talk to us about how much there has been a decrease in those imports to Los Angeles. I also wonder how you're thinking about the fall off in job listings to sites like Indeed. To what extent do you see that becoming an increase in unemployment moving forward, both in terms of labor market weakness when it comes to job postings and some of those sector-specific jobs we talked about?
Yeah, and that's a really legitimate concern here, especially since coming out of COVID, we know that one of the themes out of corporate America was this job hoarding, where they wouldn't let people go. They maybe overposted in terms of the jobs, hired more than perhaps what they wanted to, because they realized how difficult it was to find the talent that they needed when in that tight job market. Well, if the job market loosens a little bit, they're going to be less keen on actually replacing some of those employees. And I think that we're actually getting a slightly early read on that type of dynamic in today's report, where it showed that the average work week in manufacturing ticked down about 0.2 hours. That's one of the few components of the jobs report that constitutes a forward indicator, so a leading economic indicator, as opposed to concurrent or backward looking. And so that's something to really pay close attention to. It might be people when transportation and warehousing at the ports, where we see some of the hours being cut as opposed to jobs being cut, but they're already beginning to cut the hours in manufacturing.
Okay, so Brian, if this is indeed the last perhaps good jobs print or high jobs number that comes in for some time, as you were mentioning, and if consumers were indeed front running some of the tariffs, and that creates kind of a vacuum for dollars that are able to kind of slosh around thereafter for expenditures, what does that set up for the investment thesis for a lot of the traders out there that are trying to figure out which companies are most insulated from both of those major headwinds?
Sure, yeah, that's really the key thing here, and it's about that details really matter. Just look at the Magnificent Seven. Maybe you could call it a little bit of the mangled seven now, as far as how some of those stocks reacted to the earnings announcements and the guidance that was given on tariffs. You had companies like Microsoft and Meta. They seem to be holding up pretty well, but then you have Amazon and Apple that are probably more exposed to tariffs, and that is likely going to continue to show up in the markets going forward. More of what we would call the dispersion trade, where you have some that are going to probably do well, hold in there, stocks keep going up, and those who are going to struggle more. So it's really about, I think, the quality of the management. So who's at the helm of the company? What's their plan? Are they going to be able to execute on it? And so that's what we're finding. A lot of names across the board, but it's probably less of that rising tide lifting all boats, the V-shaped recovery that we had coming off of that April 9th pause. And it's getting to that point now where it's going to be a little bit more of the turbulence and really peeling back the layers to find the opportunities.
All right, Brian, thanks so much for joining us here this morning. Appreciate the time and insights.
Thank you.
Berkshire Hathaway's annual shareholder meeting kicking off this weekend. Warren Buffett's cash reserves, succession plans, and commentary on tariffs in focus for investors attending. With us to break down what to expect, we've got Lee Mson, Portfolio Wealth Advisors President and CIO. Lee, great to have you here with us. You know, if you were to kind of mark down on your checklist, what is the priority for investors who are kind of using the Oracle of Omaha as their North Star for their investing thesis? What should they be paying closest attention to here?
First of all, I think that the thing that is most misunderstood is the cash hoard. I've never seen people so interested in that cash hoard. It's been going on for months. It happened because they sold Apple. It was a huge position. I think that this is what you should learn from it. It's not about, did Warren Buffett have a bunch of cash because he knew all these things were coming? It's that when you have 3, 4, 5, 6, 700% gain because you bought Apple 10 years ago and you made a good buy, it's okay to bring down that concentrated position. It's okay to take some profits, circle the wagon, and do some research and not just put it right back in the market the next day because you read something on Wall Street Bets. So I am interested in what they are buying. We've seen over the last so many months, they've picked up some aerospace. They've got this little company called Heiko. I own something sort of in that space called TransDigm. The other thing I want to see is buybacks. Are they going to be increasing buybacks? That tells you, basically, do they think they'll make more money, erasing and incinerating Berkshire Hathaway shares, or do they think they can make more investing? But I think that for me right now, I want to know about succession. I want to know if Greg Abel's really going to take over. I want to know what kind of size he's going to be trading, what kind of responsibilities he's going to have, because I think for a shareholder, that's where it's at. Let me just warn everybody. There's two things not to take away. A, don't read into the cash hoard. That just has to do with their own rhythm and this Apple position. And number two, Warren Buffett, I love him. I've studied him my entire life. But he's not good on the macro. He was wrong about inflation for 30 years. So you got to stick to the things he really knows. And that's how you read him to perfection. So when he starts talking about stuff at Geico, the information they have from the insurance arm, when he talks about those type of trends, that's what you want to focus in on because that's what they have the most data and that's where he's best at forecasting. What you want to do is you want to separate out the throwaway comments he might make on inflation or other macro things because, I'm 50, guys. Every 5 years, I read about how Warren Buffett tells me, I was wrong about this macro call. I was wrong about this macro call. It's like Groundhog Day. Yeah. So just take it with stride, really look at what he's buying, and generally buy it 6 months later.
Well,
they're not good traders.
Let me double click on that because what's really interesting about what you're saying is don't read into the cash hoarding. However, Buffett himself has said there just wasn't an opportunity that I liked to put that money to work. Can investors anticipate hearing from him over the weekend about opportunities to put that cash to work?
Well, that's what we're all hoping, right? That's what we're always hoping and praying every time we see one of these meetings is he's going to say, hey, I bought a couple new things, right? And I have no idea what that's going to be, but that's what you really want to focus your attention on because it tells you sort of the forward trend of what he's thinking about and where he thinks value is. But remember, they do make bad calls. They do get in early. And I think that for investors, don't, just because you hear it, don't go out, it's like the stockbroker on his first day. He goes down to the payphone, and tells his dad, I just heard the most amazing story. You have to put all your money into it. But I do think I'm interested if he's further investing in aerospace, if he's further investing in things in that military industrial complex. That's where I'm most focused on, and I want to see if he's increasing the size of some of those bets. Because remember, as far as what they really own, it's a bunch of Apple, and then the next two positions are Amex and Bank of America. And that's really the bulk of what's going on. So it's going to take years for them to really pump up these other positions. So go slow, do your own research, and just do what Buffett did.
But they trimmed a lot of that Bank of America position as well coming into the start of this year. So to your point, where are you kind of front running the trade that could be announced? Are there specific companies that you're looking at right now within your own portfolio that also might overlap in the Venn diagram with Berkshire Hathaway that you're leaning further into in anticipation of what they could say?
Yeah, I mean, most directly, like I've said, aerospace. I think we're going to see more in their investments that they made later last year with HEICO. You just think about choppers and jet planes and all the parts that have to go into that. There's such a huge runway, so to speak, for OEM parts and all of that stuff going forward. I think the other thing that it's telling you is banks aren't where it's at. Right? Everybody talked, after the election, how banks were going to dereg, how all this is going to be great stuff. I think that you can see from his moves that he doesn't really think that that's going to be the same type of momentum as other places. I also think that you want to look at any type of industrial manufacturing that he's purchasing. I'm always looking at what's going to do well over the next 10 years, not the next year. And that's what we're going to see. So I think financials are out. I think aerospace and those type of things are in, and we'll get more information from them. We'll see.
Yeah. So Lee, I'm fascinated in you also saying that Buffett, he's not that great at the macro, but one thing investors certainly want to hear from him is his reaction to tariff policies. We haven't heard much from him on that. How much do you think we will hear?
Well, my young analyst just sent me, as if we just discovered it, Fortune magazine, 2003, all Buffett was talking about 22 years ago was basically, we've got to have tariffs, we've got to deal with the trade deficit. So it's going to be interesting because he's a Democrat. I'm a liberal guy myself. But how is he going to react 22 years later from his own assertion that we've got to stop this trade deficit 22 years ago, that we have to have some form of tariff. He had some gimmicky thing called import certificates that he was floating around back then. I was there. And so now granted, he could say it's too fast. We all agree. He could say it's executing improperly. We all agree. But I'm really curious to say if he's going to say anything to the effect that we shouldn't be cutting new trade deals because we should be, and that we shouldn't be addressing this trade deficit because that's always been something that's been a theme of his. So we'll see how politicized he's going to get. I think people are going to be surprised about a more moderate tone on the tariffs, but also, we all got eyeballs.
We didn't have the first iPhone 22 years ago, though, Lee.
Yeah, I know. It was a very different world. And also, it's a very different world from the 80s. A lot of people like to show that speech from Reagan about how tariffs are bad.
Right.
It is a different world, but I'm just as curious as you. But I do think the bottom line is don't read into cash. Listen to what he knows about the insurance business. It's what he knows best. And I think it's out of the financials and back into things that, making things and stuff we need.
All right, Lee, we got to leave it there. Thank you so much. Shout out to the young analyst sending you the articles. Really appreciate it, Lee.
Jesus.
Let's get a check in on some of the market movers this morning. Taking a look at shares of Apple down a little over 2.5% off the back of that services revenue coming in a little bit soft here and concerns about that $1 billion hit on tariffs over the course of the next month potentially. Let's take a look at Amazon as well. Taking a look at that stock this morning, actually recovering a bit off the back of their earnings. That stock is up a little over 1.5%. Let's look at the major averages though, because off the back of that jobs report, we're continuing to see gains across the Dow, the S&P, and the tech-heavy NASDAQ, which is the winner of those three, up 1.3%. We'll be right back.
Now time for some of today's trending tickers. We're watching Nvidia, Block, and Reddit. First up, shares of Nvidia are up over 2% as the information reports it plans to tweak its chips for export to China as U.S. chip curbs are set to go into effect. Additionally, Nvidia getting a boost as Amazon's capital expenditures for the first quarter just over $27 billion, putting it on pace to hit its $100 billion company executives citing Amazon's plans to grow capacity for AI infrastructure. So some of the tie-in in these partnerships as well for NVIDIA, which have become headlines in themselves, any type of the purchase orders or ultimate data center moves that could help out NVIDIA in moving its chips into some of those data centers as well. Also, of course, a few weeks back and now once again announced at a lectern in the White House, NVIDIA planning to produce up to $500 billion worth of AI infrastructure in the United States. Those partnerships going to be with the likes of TSMC, Foxconn, Wistron, Amkor, and more.
Yeah, this is something that we were talking to Kevin Mann about yesterday, the idea that as these hyperscalers announce continued AI capex, who does it benefit? Of course, NVIDIA, but also some other AI names. I do want to double click on this information piece. NVIDIA working on China-tailored chips after the U.S. export ban. We know that CEO Jensen Huang was at the White House this week, according to reports, imploring the president to reconsider chip export controls because those obviously put a strain on the business. And there has been some other reporting about the idea that NVIDIA may be even willing to spin off part of its China business to get around those export controls. Of course, off the back of this reporting of China-tailored chips, the stock is moving to the upside. Next up, Block shares sliding after the company cut its full-year profit outlook, citing an uncertain environment and lower consumer spending. The payment processor also missing Wall Street's expectations for the first quarter on the top and bottom lines. Block reporting softer cash at profit growth than expected with lower discretionary spend in the most recent quarter. The share still down nearly 20% in the pre-market here, just a huge slide for the company.
Yeah, a few of the takeaways here, especially as the revenue had hit $5.77 billion, that was below the forecast. And then additionally, gross profit, that was still up 9% year over year. A few of the things that the company was talking about on the earnings call and really did need to address some of the macroeconomic pressures and what that would mean for consumer spending. Of course, remember, Block, parent company of Square here, formerly Square, the artist formerly known as essentially. And if you did see any change, severe change over an extended period of time in volumes, that also impacts the percentage that Block essentially has in its own servicing and processing fees as well through those transactions. But ultimately, on the earnings call, they did talk about making sure that over this time, in some of their estimates for GPV growth for the month of April, actual April results, they could differ from their estimates, not be reflective of performance for the full second quarter. So it's even making some of the forecasts net a little bit more murky right now.
Absolutely.
And then finally here, let's talk a little Reddit. Continuing gains after swinging to a profit in the most recent quarter. In addition to earning 13 cents a share in the first quarter, Reddit also reported a 31% gain in daily active users and a 61% increase in advertising revenue. Reddit issuing strong guidance for the second quarter, expecting continued gains and revenue between $410 and $430 million. Shares higher pre-market by 3.6% right now.
Yeah, it's a beat across the board. I'm taking a look at the note from Laura Needham, who we're going to talk to in a minute here about some of these results, but calling it a strong first quarter of 2025, raising the estimate and the price target for the stock, talking about that 61% year-on-year revenue growth. As you mentioned, Brad, ad revenue up 61% year over year. Also taking a look at logged in users up 23%, daily active users up 31%. Huge beats across the board. And this, of course, coming from a company that was very successful post-IPO, did have a tiny little weakness, I believe, last quarter here, and now seeing that recovery to the upside in an environment where not everybody is winning when it comes to ad revenue on the internet right now. And you can scan the QR code to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, shares of Chevron and ExxonMobil are on the move after reporting earnings. Chevron, if we can take a look at that stock, you see Chevron moving lower, Exxon moving to the upside, but Chevron cutting plans for its share buybacks, while ExxonMobil gains after reporting it is on pace for its planned $20 billion in buybacks. Both companies dealing with a slowdown in oil prices as well. Joining us now with more, Dan Dicker, the Energy Word founder. Dan, great to speak with you here. I want to start with your overall takeaway from how these two firms were able to handle the slide in oil prices that we've seen over the course of the last quarter. To what extent did that impact these names?
Well, both have reported. I mean, the expectations were already very bad for both Chevron and Exxon. Exxon executed better. I mean, they definitely beat the expectations, but their expectations were down for the last 3 quarters, and obviously, it's based on an oil price that is continuing to be under pressure, and with increasing recession risks that continue to build out there. It doesn't bode well. To this morning, I mean, obviously Exxon's doing a little bit better in the market than Chevron is based on that better execution. But the bottom line problem for both of these companies is clearly price of oil. And that's something that they're going to have a difficulty maneuvering going forward, both of them.
Yeah, oil, even with some of the interim rebound that we've seen, is still set for another weekly loss here. And so all of that considered, as you're kind of looking out into the future and the forecasts for both of these companies, you have a president that's talked about drill, baby, drill, but for these companies that are also trying to maintain their own margins and, have a duty to investors to really showcase what that pipeline looks like for the future prospects of the business. How are you kind of drawing a line between the two? What is kind of talked about from the administration side, but what's the reality for the business and the industry more broadly?
Yeah, I mean, quite frankly, the whatever it is that the oil companies managed to get out of the White House in terms of a couple of cabinet picks and so on is not being reflected in terms of positives for the companies compared to obviously the tariff problem and the recession risk that's going into it. I mean, you don't have to be a genius to realize that these companies rely upon a price in order for them to make profits, and it's just not there. I mean, at this point, I've been negative on majors since the middle of 24, actually, as these kind of supply demand numbers have gone against the oil companies for a while, and that's proved out, and it's getting worse all the time. I mean, I've been trying to tell my investors that the best values are really in the renewable sustainable space. Unfortunately, the Trump administration has de-incentivized all of that as well. I mean, they've stopped payments on the Biden Inflation Reduction Act that was helping all of these renewables gain their footing. And so right now there's dead money everywhere in the energy sector. I mean, I can't tell people to put money into Exxon or Chevron. I can't tell people to put money into Constellation or First Solar. And, I tell them that they've got to sit back, at least in the energy sector, and wait and maybe put their money in Bitcoin, because it seems like that's what the president is interested in pushing forward.
So you're saying there's no opportunity within the energy sector right now, even when you do, you have Exxon maintaining buybacks, that doesn't entice you?
Well, they've been maintaining buybacks for many, many years, and they're solid in that. So what I tell people is that, you can own majors, but depend upon the dividend, depend upon, the bond, like a bond, and play it that way. I mean, you basically are looking at a company that has very little upside alpha that's going for it. And, so basically what you're dealing with is something that's very much like a fixed income kind of investment. Now, a lot of people don't mind having something like that. I have, majors in my portfolio too, but I don't take it as something that's this tremendous opportunity for, a 20 or a 30% gain or something even better than that.
Dan, good to get your perspective as always. Thanks so much for joining us this morning. All your markets action straight ahead. Stay tuned. You're watching Morning Brief. All right, taking a look at some of the futures coming into the start of today's trading activity. We are higher across the board off of a better than expected jobs print for the month of April. 177,000 jobs added during the month. Unemployment rate largely in line with expectations, actually was spot on. And then additionally, just barely missing some of the expectations on the year-over-year average hourly earnings increase. There you're taking a look at today's esteemed bell ringers here. Just a few of them, a handful of them at the NYSE. No doubt some great vibes though. And at the NASDAQ, you've got some funfetti in the air on this Friday to end some consecutive sessions of gains. We'll dive into that just a little bit more. But here's a look at where we begin today's trading activity. Just as we were seeing in the futures, up 1% pretty much across the board for the Dow, the NASDAQ, and the S&P 500. Let's take a little bit of a deeper look, 5-day view here. So trailing 5 sessions here for the Dow Jones Industrial Average, you're seeing gains of about 2.6%. NASDAQ Composite, you're seeing that also higher here out the gate this morning. That hasn't been consecutive gains all the way, but it is still net higher by about 2.8%. And then additionally, looking at the S&P 500, that is higher by about 1% here over the start of today's trading activity. Just early seconds here. We're not even a full minute into today's activity. And let's take a look at the 11 S&P 500 sectors to see who's out of the gate and out in front. XLF Financials catching a little bit of a bid here. That's up by 1.6% to start off today's trading session. 11 S&P 500 sectors, 11 gainers. We like to see it here on a Friday here, something that perhaps we can sit down easy over. But all right, this is where we got to kind of tune in here and watch how this one transpires over the course of the trading session. Apple reported earnings after the close yesterday. We've been breaking that down for you here all morning, and we're going to have a deeper discussion on that in just a hot second. But taking a look at the shares here, they are lower out of the gate by about 4.3%. That is just one of a few laggards for the NASDAQ 100.
Checking in on shares of Apple and Amazon at the market open here, seeing shares of both companies moving to the downside, falling amid tariff and consumer concerns. But our next analyst says Amazon could be a defensive play. Joining us now, we've got Laura Martin Needham and Company's senior media and internet analyst. Laura, great to have you. I do want to start on Apple. You've got a buy rating and a $225 per share price target here. That almost $1 billion hit for Apple, though, in just one quarter off the back of these potential tariff implementations here. Can Apple really survive these tariffs in the short term?
So one of the things it said yesterday was that almost all of their U.S. demand will be met by India and Vietnam starting next quarter. So iPhone will be coming out of India, and Vietnam will be doing iPads and wearables and Macs. So, and then they're going to spend $500 billion they've committed to Donald Trump over the next 4 years to bring a lot of that production into the U.S. So I think they're trying to pivot away. And then China will meet the rest of world needs where there isn't a tariff problem.
And so this business, most of it, half of it is still essentially the iPhone here. And so ultimately, what are we seeing them do? What did you hear that sticks out on what they may need to do with pricing in this interim period of time where we know the consumer and the sentiment has wavered?
Right. I think they're going to need to take margin pressure. I think you're going to see their earnings per share fall because I think it's better for them to maintain their installed base by cutting price and driving unit sales during this period of tariffs. So I expect Apple to eat some or all of the tariff increases and then let the extra costs fall to the bottom line. But on the consumer side, I think they'd be smart to keep the prices steady.
What is an acceptable range for margin pressure that you would be anticipating?
Well, they said it was going to cost them an extra $900 billion in the June quarter, and I expect all of that to, and they took it in their guidance to hit the EPS line. So basically, they basically told you they're going to eat the entire extra cost and not raise price.
And I heard you talking about efforts to move production and supply chains over to the likes of India and Vietnam, but that's obviously something that Apple had already been iterating on since Trump's first time in office and the implementation of these tariffs. Can moving production out of China really be any kind of solid buffer for the company and therefore for investors in the short term?
So, I mean, there's two negatives in China. You saw that the revenue coming out of China's iPhone sales in China was down 2% after being down 11%. That's really hard for Apple to do anything about because there's a sort of nationalistic, rise of nationalistic feeling in China. And so they're not buying American specifically, and Apple's getting hurt by that. So you can't really fix that if you're Apple. But in terms of, they say they're going to double the manufacturing in India this year, which then allows them to have all the US iPhones coming from India, which has a lower tariff than China. And China iPhones will just feed the rest of the world. Because remember, like iPhone sales in America are like 20% of their total. So India can handle 20% of total iPhone sales.
And so that's kind of a kind of two-way punch here from what we've been monitoring coming into the start of this year, both on the nationalistic sentiment for purchasers and consumers in the greater China region for Apple, and then additionally what IDC was anticipating in the growth of the worldwide smartphone market led by Android growth, not iOS. So what is the kind of longer-term ramification that you're measuring Apple up against in some of their efforts to retain the market share that they've been able to successfully build up in that region?
Right. So I think the most important thing is Apple needs to give like holders of iPhones reasons to upgrade or to trade in because their price point's pretty high now. So if you had Apple Intelligence that was doing a lot of really interesting new innovations, I think like consumers would be more likely to trade in their iPhone for the new one because they would want the new functionality. And the problem really is Apple has been very slow at innovation. On a consumer-facing innovation. So to me, this is sort of self-harm. They need to do more innovative things in a consumer-facing way that get consumers to want to upgrade the iPhone. And every quarter they come out and they say, oh, we have a new color. Well, you know, a new color, since all of us use an iPhone case, doesn't really drive iPhone sales.
Yeah, no, you're right. And I'm still on the 12 Pro Max, so maybe I don't have much to really offer here to this conversation because I need to upgrade myself. But perhaps I am one of those people that needs to help contribute and do my part for the next super cycle. We'll leave that up to, you know, how long this one lasts. But at the end of the day, Laura, we're going into a weekend where we're going to be hearing from Warren Buffett, who had famously trimmed some of their position for Berkshire Hathaway in Apple. What should investors be doing with Apple shares right now, going into what we might hear from the Oracle of Omaha and coming off of these earnings?
Right, so we have a buy here on Apple. We think it is a great place to hide if you, A, think generative AI hype is too much, because if you look at the other big tech names, they are spending almost $100 billion each, round numbers, between like 75 and 100 billion on Gen AI. So if you are really worried about Gen AI and the hype and the timing of the returns on that capital, Apple is a great place to hide because they just announced that they're going to buy in another $100 billion of their shares. So they're shrinking their capitalization. They're in the market supporting their own stock price, and they're increasing the dividend. So if you want a place to hide and you sort of think the Gen AI is overhyped, this is the big tech name for you.
I want to switch gears a bit and talk about Amazon. You really perked me up this morning when I got your note, and the headline was, "Is Amazon defensive?" Laura, walk me through your bull case for this name.
Oh, that was so interesting. I thought that was the most interesting thing coming out of the call last night. So the CEO here, Andy Jassy, said, look, what people forget about Amazon is Amazon's sellers are Chinese sellers. He says people we compete against typically they buy from Chinese sellers, they mark it up, and then they compete against us. So his point was, look, if our Chinese sellers are raising price to cover new tariffs, we still have the lowest price point because everyone else has another layer on top of that Chinese seller that they have to make more money from. There's an extra margin built in.
Yeah.
So I thought that was really interesting. And then the other thing they said that was defensive, they were arguing they were defensive, which I just never heard before. They also said another reason that we're sort of defensive is something like 25% of their total sales are Amazon basics. And basics are exactly where consumers go. It's like a white label idea. When they're under pressure, to save money. And then they said trust. When uncertainty rises, people go to suppliers they trust, and they trust Amazon because you don't like something, you just return it, and Amazon gives you the money, sort of no questions asked. So they said they typically gain share in economic weakness and economic downturns.
Laura, thanks so much for taking the time. We're tracking Amazon shares throughout the rest of the day. We know you will be as well. Good to see you. We have an update on President Trump's tariff policies. A loophole that previously saved Americans on low-cost items is no longer in effect. The de minimis exemption, which allowed shipments of goods under $800 to come into the U.S. tariff-free, has ended. Shipments from Chinese e-commerce giants like Shein, Temu, and Alibaba will now be subject to the 145% base tariff on all Chinese goods.
Another tariff headline we're watching. President Trump's 25% tariff on auto parts goes into effect Saturday. That's separate from the 25% tariff already in place for all auto imports. But earlier this week, President Trump did sign an executive order to soften some of those levies. One exemption now prevents tariffs from stacking on top of each other. The move is also retroactive, so automakers can be reimbursed for tariffs like those on steel and aluminum if they already paid them.
With that in mind, the other executive order provides some relief if final assembly of cars is done in the U.S. A Commerce Department official says these changes will help automakers get more lead time to adjust to tariffs. Barclays analyst Dan Levy doesn't see the exemptions as materially changing the landscape for automakers, saying they expect benefits to be somewhat limited versus the greater tariff costs.
And Ford said recent changes on tariffs are helpful, but more work is needed on the policies. GM cut its profit forecast for 2025 by more than 20%, saying tariffs could cost up to $5 billion. And Stellantis suspended its full-year outlook due to tariffs. It's been 1 month since President Trump announced his slate of country-specific tariffs before pausing them for negotiations. No deals with individual countries have been made yet.
We've got all your markets action straight ahead. Stay tuned. You're watching the Morning Brief. Happy Jobs Day. Let's send it down to our own Jennifer Schonberger standing by with a special guest. Jennifer.
Thanks so much, Brad, for more insight on this morning's jobs report. I want to welcome into the program, and a first on Yahoo Finance, Labor Secretary Lori Chavez de Reamer. Secretary, thank you so much for joining me. It's great to have you on Yahoo Finance.
I'm so grateful to be here. It's nice to be here finally, and it's a great day for these jobs numbers, aren't it?
Yeah, much stronger than expected jobs report this morning, even as we've been hearing sort of a wait-and-see approach from employers. What was your takeaway?
Well, we blew it out of the water last month, so this does not surprise me. This is exactly what I knew the president was going to do, but 40,000 more jobs, again, exceeded expectations. So this is not a wait and see anymore. The golden age is here. This is what we're experiencing. This is what the president wanted when he put this team together, and we're working hard to deliver for the American people.
I know you have been on the ground observing the labor market firsthand, talking to employers, talking to workers. What are you hearing? What are you seeing? And how does that stack up with the official data?
Well, I think it's measuring exactly to what the president said. As I'm on the ground, my 50-state tour, visiting with businesses here right at the Department of Labor, we're seeing the excitement and the investment that they want to make. I mean, look at the companies that are coming and negotiating with the president, almost $8 trillion worth of investments. That's only going to grow the jobs market. That's what's key for me, is to make sure that we have that skilled workforce. So as we're on the trail, almost 500,000 new jobs have already been created in this administration, and we're going to see more and more as we continue down the months ahead. So I'm excited to report on these things, and then I'm excited to go back and continue on the road and talk about these things, because that's just, people get excited about this. They want to be investing in the workforce, and we want the American worker to know that they're secure and they're safe and they have jobs to choose to.
Sounds like you're hearing a strong picture on the ground yourself. I'm curious, with the announcement of the tariffs, they've been paused, most of them, but we do have some in place. What impact are you hearing in terms of how tariffs could impact hiring? What are you hearing from employers?
Well, the president assembled a great trade team. When I think about, the Treasury Secretary, when I think about the Commerce Secretary, when I think about the trade representative, their job was to negotiate with a lot of these companies to repatriate back to the United States, and then we're seeing those investments. I mean, we saw companies stand up and say 50 billion, 500 billion, even some companies that are saying, I want to do 100 million. I want to be part of this. Mm-hmm. When we skill this workforce, the concern for the tariffs, it was fair trade practices is what the American people deserves. That's what the president said he was going to do. That's what he campaigned on, and now he's delivering on those promises.
To your point, this week we heard from Commerce Secretary Howard Lutnick, who says he expects tens of thousands of jobs to be created from the reshoring of automakers' plants to the U.S., as well as investments from the likes of Apple to NVIDIA, Taiwan Semiconductor. My question is, will it be a couple of years before we see the real fruits of job creation from these investments? And could there be some pain in the short term as you look to position the job market for stronger growth?
Well, I certainly think the Commerce Secretary is correct in the fact that as they've done these trade negotiations and companies are reinvesting and really finding confidence, they need that workforce. So my job is to be on the ground and do so. As we build manufacturing, I mean, think about transportation jobs are growing month over month. Manufacturing jobs have grown month over month. The workforce is going to be necessary. It is my job then to follow right behind my partners in the cabinet and make sure that workforce is there. Is there going to be pain? I don't see it as pain. I think of it as positive growth for the American people. The expectation is there. And also I think about the Secretary of Energy, or I think about Congress and deregulation. We want to move things faster, and I'm going to do everything I can to have that workforce ready. So when they do their job, I come in right behind and those businesses are secure.
Madam Secretary, what about on the government side? We saw 9,000 jobs that were cut from the federal government last month. We know that the DOJ has been looking to cut federal government jobs. What can we expect in terms of the impact going forward when it comes to DOJ's cuts? Because this seems like sort of a minimal amount, if you will.
Well, the mission of DOJ was to streamline, modernize, do more for less. And that's what we're seeing. But when you're talking about negative impacts, there isn't one, because what we're seeing is an increase in a lot of the local public officials growing. So closer to the people. I was a former mayor. Being as close to the people as possible is what's key. So yes, the federal workforce is on the decline, but the private sector workforce is increasing, and the local sector of public workforce is increasing. So, this is all positive. We see no pain. We see no disappointment. These are good numbers. This is a good day for America. This is a good day for the American worker.
Madam Secretary, I want to ask you about the ports have been warning that we could see a drop in cargo that is imported to this country because of the tariffs that were announced on April 2nd. They're talking about the potential of some goods that could be harder to come by, the potential for shortages this summer. What steps is the administration taking to guard against this sort of risk?
Well, certainly anything is going to be better than the past administration when we saw post-COVID, and we saw all the issues that were happening in the ports. That is not the goal of this president, is to make sure that we have the resources that are needed. I just visited the Port of Miami to see what they're investing in. They want to make sure that we're moving goods and services as needed so that we can have more confidence for the American worker and for the American business to get their goods and services out. And again, the American workforce can grow, and American businesses can be confident that their investments are going to be secure. That's what the president's job is, and that's what he's done. And I will tell you, working for this president, assembled with this team, the golden age is, again, it is among us.
And before I let you go, this week we did see the administration offer some tariff rebates for automakers as they look to reshore their factories here in the U.S., so kind of offering them some relief over the next couple of years. Could we see the same relief offered for other industries and for other companies, especially those who are sourcing from China? We know so much production comes from China as companies look to hopefully reshore here in the U.S.
Well, fair trade practices, again, what the president was looking for. And as he's assembled that trade team, I'm not part of the trade team. So the conversations about rebates, that'll be amongst them. But I know the president has a plan. He does a wonderful job at doing it. He's a master negotiator, as we've seen. And that's why you're seeing these companies reinvest for these fair trade practices. And at the end of the day, we're going to see our American workforce grow, and people are going to keep more of their hard-earned dollars as we continue to upskill and reskill our American worker. This is the greatest job that I've ever had working for this president. But as we see these numbers, we know we're doing the right thing.
Madam Secretary, thank you so much for your insights. So appreciate it. Hope to speak
nice.
with you again
Nice to
soon.
be here. I look forward to it.
Fantastic.
Thank you.
Maddie, I'll send it back to you in New York.
Thank you so much, Jennifer, for bringing us the great conversation. Really appreciate it. Let's do a final check on the markets before we head to break here. Taking a look at the major averages, all moving to the upside. You've got your S&P 500 up about 0.8%. Your tech-heavy NASDAQ is also up about 0.8%. The level that we are watching, the level that the stock market hit the day after that so-called Liberation Day on April 2nd was 5,345. Right now, the S&P 500 is above that level. Will we see the market closing at that level, recouping all of those post-Liberation Day losses? That is what the market is on track for at the moment. Let's flip it over to the bond market, though, taking a look at yields continuing to move to the upside as we're potentially getting a little bit of a fall in Treasury prices as investors seek out some of that more risk on trade when it comes to the stock market. And you've got your 10-year yield. It's up about 5 basis points, continuing to see that trend of the longer end of the curve ticking higher. You've got your 30-year yield up nearly 4.7%. It's up also about 4 basis points as well. That's off the back of that jobs report. That's going to do it for me for Morning Brief. Join me in the next hour for more analysis on Catalyst and Brad for Wealth after that.